Hi, Scott Nelson, Senior Wealth Manager at Boulay Financial Advisors with your review of the markets for the fourth quarter of 2022. Here again is that chart showing the rise of the 2-year and 10-year Treasury bond yields over 2022 in response to the Federal Reserve's raising of interest rates. The 2-year Treasury yield remains above that of the 10-year Treasury in a situation we refer to as an inverted yield curve. But you can also see that these yields have leveled off in the fourth quarter, as it appears likely that the Fed has started to slow down on its hiking of interest rates. That stabilization of yields gave the bond markets a chance to rally in the fourth quarter. Overall, U.S. bonds were up approximately 1.85% per the Morningstar Core U.S. Bond Index. All the bond sectors were up for the quarter, with high-yield sector leading the way with a gain of just over 4%. Corporate yield bonds were up 3.7%, and government bonds eked out a gain of just under 1%. Still, combination of very low interest rates to start the year, followed by several rounds of aggressive interest rate hikes, made 2022 the worst year for the bond market since they started keeping track of these things. The stock market also rallied on the assumption that rate hikes would be less aggressive going forward. The overall U.S. market was up a bit over 7% per the Russell 3000 index in the fourth quarter, but still ended the year down over 19%. Its worst showing since 2008. Now you can see, though, that large cap value stocks had a pretty good quarter, up nearly 15%, which led them to be only down 2% for the year per the CRSP large cap value index. The biggest source of the value stock gain was the oil sector, which was up 21% for the quarter and up 62% for the year, courtesy of the Ukraine war. Large cap growth stocks were essentially flat for the quarter, but ended a year down 33% as the exuberance over tech companies faded in the face of higher interest rates. International stocks did well in the fourth quarter as well. The MSCI All-Country Index, that excludes the U.S., rose over 14%. Notable was the 19% gain in European stock markets per the MSCI Total Return Index, as the continent's energy crunch seems to be easy courtesy of a warm autumn. China's government announced stimulus measures and abruptly dropped its zero COVID restrictions in the fourth quarter, which sparked a 13.5% rally in the Chinese stocks. That development helped power the MSCI Emerging Market Index, up 9.7% for the quarter. Part of the Chinese New Year experience is a group of people going around banging drums to scare away evil spirits. I think many investors would have liked to scare away the spirits of 2022 with a little bit of noise, but it's likely going to take a bit more than that. Economists will tell you that when a Federal Reserve takes significant action, it takes 6 to 12 months for the full impact of those actions to hit the economy. And we are just at the point where we're likely to see spending by consumers and businesses weaken in the coming months. So expect the markets to stay volatile as earning reports and data on consumer spending come out. The silver lining to all this is a slowdown is exactly what the Federal Reserve wants to happen in order to knock out inflation. A period of recession is much preferable to years of inflation. And what comes after that is an economy that is in a better place to grow, and an equities market that is better priced for sustainable growth going forward. So let's hope that 2023 does indeed be the year of the rabbit, which is supposed to bring peace and prosperity. So there is your market review for the fourth quarter of 2022. As always, if you have any questions or concerns about your investments, please reach out to your Boulay Financial Advisor. If you're interested in learning more about Boulay and Boulay Financial Advisors, please contact us at learnmore@boulaygroup.com. Until next quarter, hope you have a prosperous start to your new year.